Hey, yo, what's happening, guys? Fellow dividend enthusiasts like myself, I think we need to talk because we all know that the standard just by VU and forget it advice could be a recipe for disaster. While the AI hype continues to hijack the market narrative as in the past few years, it's created a massive concentration risk in the S&P 500, the likes of which we've quite literally never seen before in modern stock market history. By mid 2026, the top 10 companies in the S&P 500 made up nearly 40% of the entire index. For context, at the absolute peak of the dot-com bubble in 2000, that concentration only peaked at 27%. Furthermore, according to AI, the top 3 companies alone frequently accounted for 30 to 40% of the entire index's annual gains. But this isn't news to you guys. We all know this. That's why they call us contrarians, because we focus on dividend growth and earnings sustainability. Let's call it what it really is. We're fundamentalists. We invest in resilient companies with proven competitive advantages. But while it's exciting that dividend investing is increasingly popular, the space has flooded with total nonsense. And today, we're breaking down what I think are the 3 biggest misconceptions, including one that may completely derail a beginner investor's retirement goals. Let's get into it. The first misconception, is that dividends are free money. As beginners, we love the idea of being able to live off our dividend income when we retire because we won't be touching our investment principal. But the cold reality, though, is that you are touching your principal. The companies paying you these dividends are just doing it on your behalf. Think about basic corporate finance. A company makes a profit. It can either reinvest that cash to grow the business or distribute the leftover cash to shareholders in the form of dividends. What I think people tend to forget is that the dividend is directly subtracted from the company's assets. When they pay it out, cash drops on the balance sheet, and consequently, the company's market value drops by that exact amount. Did you hear what I just said? Because your portfolio value drops by the dollar value of the dividend per share. Let's look at some data together. On the Yahoo Finance page over here on the left where it says historical data, you'll see the market at open and close prices for each trading day with an adjusted close section over here on the right. When Apple went ex-dividend on May 11th, 2026 with a 27-cent dividend, it closed the previous trading session at $293.32. But look at the adjusted close the next morning. The price was automatically adjusted down to $293.05, a difference of exactly 27 cents. And it works the same way with ETFs. When SEHD paid out 25 cents per share on June 24th, its share price was adjusted down from 32.02 to 31.77 before the opening bell. If you held on to 100 shares of SEHD on June 23rd, the day before its ex-dividend date, you watched your portfolio value of $3,202 drop down to $3,177. Your portfolio value doesn't instantly magically grow when a dividend hits. Its structure just changes from stock equity to cash. The real edge for dividend investors isn't free money, it's the math of the dividend snowball. During market corrections, receiving that cash allows you to automatically accumulate more shares at a discount. That's what really accelerates the dividend snowball, or the accumulation of shares over time, not necessarily your overall wealth. This brings us to misconception number 2, that dividends protect you from a market downturn. They don't. Dividends have zero control over market volatility. If a company pays a $3 dividend this year, but macroeconomic headwinds drop the stock price from $100 to $70, that dividend did not shield you from a $30 loss. Your portfolio value still dropped. SCHD's expected lower volatility relative to VU in a market correction is entirely dependent on whether the crash was tech sector driven or some other sector that SCHD is underweight on. If SCHD somehow found itself overweight in tech relative to its other sector holdings, which is a very real possibility down the road, by the way, we may cover that in a later video about the evolution of dividend fund holdings over time. it may very well be just as volatile as VU. It's the underlying fundamentals of the value companies protecting you, not the dividend payout itself. But the desire for a faster dividend snowball is still as prevalent as ever and as understandably as ever, and it's driving beginner investors into incredibly dangerous territory, namely covered call ETFs. This is the third and most dangerous misconception about dividends, in my opinion, that higher yields always equals faster compounding. Take JEPQ, for example, a fund that receives flowery representation on many finance channels on YouTube. It boasts massive monthly distributions by selling call options on the NASDAQ 100. It sounds fantastic on paper, but standard options mechanics tell a different story. A call option gives the buyer of the option the right to buy a stock at a set price, which has to be lower than what it currently is priced at in the market, otherwise the option would be worthless. The seller of these options does not participate in the upside of said stock, but only gains by means of revenue from selling the option. But if the underlying stock of the call options crashes for whatever reason, the seller of the option captures 100% of that downside while capping the potential reversal when and if it recovers. You take on 100% of the NASDAQ crash and then struggle to recover if your strategy is heavyweight on covered call ETFs like JEPQ. In a choppy or flat market, this strategy works. But with today's historically high valuation and concentration risks, like we mentioned at the beginning of the video, a true market correction of, say, 10 or 20%, driven by prolonged high interest rates, will leave these high yield funds facing permanent principal erosion. You'll get your fat checks, but your base asset is eroding. The only way dividends truly protect you during a market crash is behavioral. They prevent you from panicking and selling out of your positions at the bottom. When you invest in a fund like VIG, which tracks the S&P US Dividend Growers Index, you know those companies are required to have a minimum 10-year track record of annual dividend growth to even be considered for the fund. These are cash-rich, low-debt giants built to survive economic winters. Their stock prices will still bounce around, but their business models aren't going anywhere. If you're an investor in your 20s or 30s, total return is what matters most. A simple VU strategy will likely do great over a 30-year horizon, but investing isn't a spreadsheet game, it's psychological. If dividend growth gives you the peace of mind to stay bought in and never panic sell, that will be your ultimate edge. Let me know in the comments, guys. Are you sticking to index funds or are you building a dividend safety net to hedge against today's mega cap concentration? Or better yet, are there dividend funds out there that this video helped you change your mind about? Like the video and subscribe for more fundamental analyses, and I'll see you in the next video.